Hello students, this is Sonette. Please note you're very welcome to contact me. The best thing to do is to send me an email. Otherwise, you can try me on my office number. I'm going to be at work most mornings, but the best thing is to send me an email. The learning outcomes from lecture 1, which you should have watched before you look at this lecture, are that we did an overview of the different types of business entities. Those were sole traders and partnerships, and then we talked about the Companies Act, and we also touched briefly on the different types of companies. So you must please look at lecture 1 and where we did the introduction to companies, and we also did accounting entries for the issue of shares. In the textbook, lecture 1 covered chapter 8 from pages 213 to the middle of page 223, which was section 833. You should also, after lecture 1, be able to do from your question book, question 8.1, 8.2a, 8.3, and 8.10. The learning outcomes for this lecture are that we're going to look at the accounting for conversion of par value shares. We're going to look at question 8.4. We're going to look at the note for share capital, which is question 8.2b. We're also going to look at how you disclose equity in the statement of financial position. And finally, how you disclose share capital in the statement of changes in equity. In the textbook, we are looking at page 223 and page 224 of the textbook. So when we deal with conversion of par value shares into no par value shares, the reason we are doing this is because in the previous regime of the old Companies Act, companies were allowed to have shares that were authorized at a par value. So when the company was incorporated and they authorized the number of shares that the company was going to be allowed to issue if it wanted to in the future, then the shares also used to have a value per share, which we would call the par value. So a company, for example, might have decided they wanted to register 100 authorized shares at a par value of R2 each. In the new Companies Act, we don't have par value shares anymore. We now only have no par value shares. So in the new Companies Act, when you register your company, you register it with an authorized number of shares, but you don't give the shares a specific par value. When you issue the shares, you decide which price you want to issue the shares at that point, depending on what you believe you'll be able to get in the market for the shares that you're going to issue. But the old regime was that when shares were issued, the shares were issued at a par value, and if you went above par value, then you had to create what we call a share premium account. So now let's talk about that. So in the old Companies Act, when you registered your company, you authorized the number of shares that you had in your company with a specific face value or par value. So let's say you decided that you were going to set up your company with shares with a par value of R2. Then the issue price, when you finally do issue your shares, let's say you're issuing them now for more than par value. So AB Limited issued 100 ordinary shares that had a par value of R2. They issued them at R2.30. So in this question, you will see the par value is R2, the issue price is R2.30. So that difference of 30 cents we call a share premium. So the entry in our books would have looked like this. We would have received R2.30 for each of the 100 shares, so the company would have received R230 into its bank account. We would debit bank. We would credit ordinary share capital with the par value of the shares. That's the R2 at 100 shares, it's R200. So in your ordinary share capital account, you only ever had the par value of the shares that had been issued. The difference of R30, which is the premium above par value, so your issue price was R2.30 and par value is R2. The difference of 30 cents per share comes to R30. That amount would get credited to an account called share premium. So together, the share premium plus ordinary share capital come to 230 Rand. But in the old Companies Act, where you authorize shares with a specific face value, you had to have two different accounts because your ordinary share capital account had to show the shares that had been issued at par value, and the share premium account then showed the additional amount that you issued shares for over and above par value. This is no longer what we do in the new Companies Act. But the reason why we're telling you about this is because in practice out there, there are still many companies that would have share premium accounts because they were registered under the old Companies Act. And we just need to think about what we would need to do to convert those share premium accounts into no par value shares. So in other words, the company might make a decision to convert its par value shares into no par value shares, and then we have to look at what entry we would do in our book. So now we're going to talk about how we actually convert par value shares. So what's going to happen in practice is that because we have the new Companies Act and all new shares that get authorized for companies have to have no par value, companies that had par value shares can take a decision to convert those par value shares into no par value shares. If they make this decision, they have to change the memorandum of incorporation of the company. This is the memorandum that you have to register at the time when the company is set up. And that memorandum of incorporation has to be registered with the Companies and Intellectual Property Commission, or the CIPC. So companies that had par value shares and had share premium on the par value shares have to take a board resolution that they want to change their par value shares into no par value shares, and they have to register the change. Once that's been done, we can do an accounting entry where if the par value shares had been issued at a premium, we now have to get rid of the share premium account, and we have to take the share premium account and transfer it to the share capital account. So this share premium account over here would have had a credit balance, and we're now going to transfer the credit balance into the share capital account, and we're going to increase the share capital account therefore to the full value that we received per share, which in our previous example was R2.30. Let's carry on and think about question 8.4 and look at how this is actually done in an example. So in question 8.4, we're going to record the conversion of shares in the General Journal of Space Limited. So we're going to make a journal entry to transfer share premium to share capital. Let's read the question. The issued share capital of Space Limited on the 1st of June 2007 comprised 300,000 ordinary shares with a par value of R2 per share, and they were issued at R2.50. So you'll notice here, par value was R2, the issue price is R2.50. At the annual shareholders meeting on the 30th of June 2007, they decided to convert the par value shares into shares with no par value. This was so that they could be in line with the companies that were registered under the new Companies Act and could only issue no par value shares. So what we've got to think about is the fact that this company already has shares at R2 in the share capital account. That's 600,000 rands worth of share capital. But in their share premium account, so that's capital, in the share premium account, they will have 50 cents for every share times 300,000 shares, which is 150,000 Rand. So in their current situation, they have 750,000, which is those two added together, 750,000 Rands worth of shares that have been issued, but 600,000 is current share capital and 150,000 is share premium. So what's going to happen now is we're going to take this share premium and transfer it to share capital. So the journal entry that we're going to do is that on the 30th of June 2007, we are going to be debiting the share premium account with 150,000 Rand. The share premium account would have had a credit balance. We're now debiting it. And we are going to be crediting share capital with 150,000 Rand. So remember, the share capital account already had a balance of 600,000 Rand, which was our 300,000 shares times 2 Rand each. Now we're adding to that this share capital amount of 150. So that means our share capital account will now have a balance of 750,000 in it. So let's talk about how we disclose share capital in the financial statements. In the financial statements, there are 3 places that share capital will appear. We're going to have a note for share capital. We're also going to have a statement of changes in equity with detail about share capital. And we're also going to show the amount for share capital in the statement of financial position. So to end off this lecture, we're going to look at these 3 disclosure aspects for share capital. So the first thing we're going to look at is the disclosure of the share capital note. Let's just take an example. We've got a company called Great Limited, and Great Limited will have share capital that they had authorized. That means at the time when they were incorporated, they decided they wanted to be able to have 500 ordinary shares available to be issued and 300 preference shares that they wanted to be available to be issued. And we can assume these were all no par value shares because they were issued after the new Companies Act came in. So this is an example of what the note to the financial statements would look like for Great Limited. If Great Limited had issued 250 ordinary shares, let's say they'd issued them for 8,000 Rand, and they'd issued 180 preference shares for 6,500 Rand, the total share capital for Great Limited at the end of June 2002 would be 14,500 Rand. This amount we will put onto the statement of financial position, but on the statement of financial position we would refer this to a note, and this is note 1 here, where we have to first show how much is authorized of share capital and how much has been issued. So this format that you see here is something that you have to learn. This is the format for the note for share capital. Now let's look at question 8.2b. Question 8.2. We're required to record transactions in the General Journal of Moon Limited. This is something that you should be able to do after the previous lecture, lecture 1, being able to do the General Journal entries. What we're going to focus on here are the notes that have to be done for the year ended 28th of February 2004, particularly for share capital. We'll also have a look at the note for long-term borrowings. So let's read the question. The registered capital of Moon Limited. Registered means authorized as well. The registered capital or the authorized capital is 150,000 ordinary shares with no par value and 25,000 preference shares with no par value, which are non-redeemable. Non-redeemable means we've made no arrangements to pay back the money to the preference shareholders, which means that this is equity. If it was redeemable, That means we're going to pay back the preference shareholders at a particular point in time. Then it would mean it was a liability. But this now is equity, and the arrangement is that they get a fixed annual dividend of 20 cents in the rand. That's equivalent to getting 20% back on your money, because for every 1 rand that you've invested, you get 20 cents back as a dividend. On the 1st of February 2003, immediately after being registered, the prospectus was issued to invite the public to subscribe for 80,000 ordinary shares. They had 150,000 authorized shares. They want to issue 80,000. They've decided to issue them at R1.20 per share. And they want to issue all the preference shares. That means the whole 25,000 at R2 per share. The 28th of February was the closing date for applications. Applications were received for 95,000 ordinary shares. So now if we think about the ordinary shares, we had 150,000 ordinary shares that were authorized. We wanted to issue 80, and we actually got applications for 95. So that means there's an oversubscription of 15,000 shares. Then if we look at the preference shares, we had 25,000 authorized. We wanted to issue all of them, but we only had applications for 20,000. So that means there's an undersubscription on preference shares of 5,000. The maximum number of shares were allotted on the 5th of March, and unsuccessful applicants were refunded. The next part of the question has to do with liabilities. This is debentures that get issued. So debentures are a type of liability that you issue to debenture holders. These are people who want to invest in a business but want to get their money back and want to have a definite amount of interest that they earn. So the company decided that they wanted to finance further projects, and the directors decided they didn't want to issue further shares. So they issued securities in the form of debentures. So that means that Invested can buy debentures. On the 30th of November 2003, they issued 10,000 12% debentures. That's the interest rate on the debentures. If you wanted to pay one debenture, you paid 10 rand. The debentures would be redeemed on the 30th of November 2008, which is 5 years later because we started at 2003, and the debentures are secured by a mortgage bond over land and buildings. So in other words, if for some reason the company cannot pay back, the trustees for the debenture holders actually will hold this mortgage bond over land and buildings, so that if the company can't pay back, the land and buildings will get sold, and the money that's received from the sale will then get used to pay back the debenture holders. So let's just look at the general journal entries that had to be done. These are the general journal entries that would be required in the books of Moon Limited. On the 28th of February, which is the last date which you could apply for shares in the company, they'd received applications for 95,000 ordinary shares. So that's 95,000 times R1.20 per share. That's the amount that they offered the shares at, and they received applications for 20,000 preference shares at R2 each. So the total amount that they received was 154,000. Then they actually will allot the shares on the 5th of March. They had only offered 80,000 ordinary shares, so they're only allowed to allot 80,000 ordinary shares at a price of R1.20 each. So that means they're going to take 96,000 out of the application and allotment account and allocate it to share capital. The preference share capital, they wanted to issue all of the shares, but they only managed to get applications for 20,000. So the full amount that had been received for preference shares is going to get transferred out of the application and allotment account for preference shares into the preference share capital account. I want you to notice Preference Shares has its own application and allotment account. That 40,000 has been transferred out of the application and allotment account for Preference Shares to a separate account called Preference Share Capital, which has a credit balance. Remember, this is equity because there's no set date for paying it back. Then the ordinary shares, we had received 114,000 Rand. We were only able to issue 96,000 Rands worth of shares. So that means the difference between 114 and 96 is 18,000, which has actually been oversubscribed, and we have to refund the people who applied for those shares. So we will credit the bank account and debit the application and allotment account for ordinary shares. So the application and allotment account here has two amounts which add up to 114,000 Rand. So that account, remember, is like a clearing account which clears once we've issued the shares and paid back any oversubscription. The final entry here is just the entry for the debentures. We received the money on the 30th of November, and we will credit 12% debentures account, which is a liability account. The important part of this question is that you need to be looking at how we show the share capital in the notes to the financial statements. In the financial statements, on the statement of financial position, there will be share capital of 136,000. The prescribed way of doing the note is that you first have to show the authorized capital of the company. So they have 150,000 ordinary shares, which they can issue, and 25,000 preference shares they can issue. The fixed annual dividend is 20 cents per share. Remember, that means you get a 20% return on your money. Once you've written down what the authorized capital is, and this information you generally take straight from the question, easy marks here if you just write it down. The issued capital then, you've got to say the actual issued shares. So 80,000 ordinary shares were issued. The total is 96,000 because that was times 120 per share. And the preference share capital, we only issued 20,000 at 2 Rand per share. That gives you 40,000. So the total issued share capital is 136,000. We must always keep our ordinary share capital and preference share capital separate. Then you will remember from having done long-term liabilities, you need to have a note for your long-term borrowings. So the long-term borrowings on the statement of financial position, which I'm going to show you just now, would have a credit balance of 100,000. Remember, capital is also a credit balance. These are debentures. There are 10,000 debentures at 10 Rand each which have been issued. So 10,000 times 10 gives you the 100,000 Rand. Then this information you have to memorize what you have to say. So for long-term liabilities, you must say if they're secured, and these debentures are secured by land and buildings. You have to give the carrying amount of the assets that are held as security, because this would then refer to your PPE note, because that's where land and buildings would appear. And this security is in favor of the trustees, because remember, there's not just one debenture holder. There are 10,000 debentures. You may have 10,000 individual debenture holders, but it's more likely that people will have bought blocks of debentures. But the point is that you have trustees that act on behalf of the debenture holders. They like the holding body that looks after the interest of the debenture holders. You also have to say that the debentures are redeemable at which date, 30th of November 2008 in this case. What's important here is to realize that this means that the total liability at this stage is long-term. There's no current portion because it's getting paid back more than a year's time. And the debentures will be redeemed at 2 Rand each, and interest is payable at 12% per annum on the debentures. So that's prescribed information that you'll get marks for. You need to, with the share capital and the long-term borrowings notes, memorize the information that's required. If we now look at the statement of financial position at the end of February 2004, In the equity and liabilities section, we will have share capital. This came from the note I just showed you, 136,000. Underneath equity, you will also have retained earnings. We'll deal with that in a later lecture. These two amounts together will add up to the equity of the company. Remember, that's assets minus liabilities, and it'll be what the business is worth to the owners. So the equity is the investment of the owners. That's the amount they've put in, plus the earnings that the business has made that hasn't yet been distributed as dividends to the owners. So if the business had to sell its assets and pay its liabilities, the equity is what is left and should be paid out to them. Then the non-current liabilities, the amount for debentures we discussed in note 5, and that gets shown here as non-current liabilities because that amount is only due to get paid back in 5 years' time. The final place that we said that share capital gets disclosed is on the statement of changes in equity. We'll be looking at the statement of changes in equity for companies in more detail in further lectures. But what you need to be looking at here is that in your statement of changes in equity, you're going to have columns for everything that you find in the equity section of the statement of financial position. So in the equity section of the statement of financial position, we have 136,000 for share capital, but that 136,000 we've now split on the statement of changes in equity between what's ordinary and what's preference share capital. And also on the statement of financial position, we had a row for retained earnings, and this total here will be the total amount of equity at the beginning and at the end of the financial year. If you look at our balances at the beginning, they are 0, and the reason for this is it's the first year of the company's operation. So in the first year, we issued shares. We already did the calculation. In the statement of changes in equity, we have to show if any shares have been issued. Here we have 96,000 of ordinary shares, 40,000 of preference shares, a total of 136,000. That then becomes your balance on your share capital at the end of the year for ordinary shares and preference shares. And as I said, that then is the amount that gets shown on the statement of financial position for share capital. Retained earnings, we don't have the amounts in this question, but we will look at a later example with it. But what happens in retained earnings is you will include in this column the profit and then what happened to the profit. So, for example, part of the profits could get paid out as dividends. That would then get subtracted, and the balance that's remaining is what would be shown as retained earnings on the statement of financial position. So in this lecture, we were looking at the conversion of par value shares into no par value shares, and we also looked at the disclosure of share capital in the note to the financial statements, on the face of the statement of financial position, and also on the statement of changes in equity. For the next lecture, which is lecture 3, we're going to be going through chapter 8, pages 225 to 230.